Do you think you could get better as a long-term fundamental investor by trading around short-term earnings and other catalysts? Well, I was surprised. My name is John Zolaitis. I am the president of Quovitas Capital, and I recently gave a talk on how contributing to Alpha Capture platform helped me become a better investor. And I pitched this as inversions or challenges to principles typically held by value investors at a recent conference. Before I get into this a little bit more, I just want to mention that Quovitas Capital is a registered investment advisor in the state of New York. This presentation is not an advertisement, and you should contact your financial advisor. Our agenda will be to review what alpha capture platforms are, talk about our process for investing, and then give our inversions to challenge the fundamentals of value investors. But before I get in, I just want to mention that when I initially started contributing to alpha capture platforms about 6 years ago, I thought that I would be quite terrible at it. Essentially, these are firms that solicit trading ideas from a pre-approved panel of expert contributors. They use an algorithm or other methodologies to put those trading ideas to work with actual capital, and then they pay contributors based on their performance. About 2 years ago, my performance improved pretty significantly, and that is the genesis of this talk, what I learned in that transition. As far as our process goes, this isn't that important for you because you probably can't replicate the way that we review companies. But I think the takeaway should be that you need to have some approach, some basis for analyzing companies. Our is based on unit level economics because we primarily deal with retail and restaurant companies, and we're looking for inflections in key unit metrics that we believe can drive improving or deteriorating fundamentals. And we develop an investment narrative around that. But ultimately, what we're solving for are the following: a fundamental surprise relative to what analysts are expecting for the business, a acceleration or deceleration in fundamentals, and positive or negative revisions to earnings forecasts. Why are we looking for those things? Because companies are worth more when fundamentals improve, when earnings, margins, cash flow, return on invested capital improve, and vice versa. And because other things, other trading ideas just didn't work. Furthermore, when you look at companies, and this extends beyond trading ideas, you got to keep in mind that your capital is finite, your time is finite, your mental capacity is finite. So, why are you solving or you analyzing for things other than improving fundamentals? This brings me to my first inversion for value investors, and it is that you should start with searching for good fundamentals and then ask why the stock might be cheaper than it appears, rather than solving or running a screen for why is this stock so cheap? Why is it trading below its intrinsic value? And then trying to figure out why it isn't the turd that it looks like it is. An alternative way to put this: you should buy when the good news isn't priced in, rather than buying when the bad news is priced in. Furthermore, and one of the things that I found in a lot of the writings about investing is that there's a lot of talk about how to analyze companies and when to buy, but there's very little discussion about how to manage your portfolio once you've actually added it, once you've put the stock into your portfolio when you construct it. There's not so much financial literature out there about that. And I would argue that the decision to sell could actually be more important with regard to your investment performance than figuring out when to buy. Furthermore, you're going to be wrong a lot. And I feel like that fact is not frequently acknowledged in either value investing or other kinds of investing. And being wrong nearly half the time is a lot. And that's if you're, decently good at what you're doing. So just to highlight that I'm frequently wrong and I incorporate this into my investment strategy, here are a few of the ways that I get things wrong. And there's just, so this list could go on. And on top of that, it is possible to make a bad investment decision worse. And usually, what that entails is making excuses about why it's not working. And I think among the biggest sins that you can commit is what I've highlighted here, number seven, which is that you defend emotionally your bad trade or investment idea by adding to it. So I think you might want to ask, like, how do you know when you're wrong when you make an investment? So I'm going to give you a criteria. The criteria, which is in my second inversion for value investors, is that you are wrong when the fundamental story gets worse. Instead of shares trading below their intrinsic value justify continuing to own unproductive assets. Putting it differently, I think you need to have a plan for when you're wrong instead of being ready to find new reasons to find a stock that isn't working. What is the opposite of the sunk cost fallacy? So I want you to try to answer this question. The sunk cost fallacy is when you don't sell a stock, a piece of real estate, a car, whatever it is, when it's trading below what you paid for it because of all the time and money and mental capacity you've already put into it. What would be the opposite of that? I would argue this is the realized profit fallacy, which is when you feel like you need to sell a stock that's working to justify the past investment of time, capital, mental capacity, that you think the act of selling proves that you were right, that to invest this time in it. And I feel like that is also an error. And hence, my third inversion for value investors, you should recognize that a great stock is rare and owning them should be cherished like a very wonderful, rare bird. Instead of, it's more important to find the next unloved bargain. Put differently, you need to maximize your winners, have a plan to maximize your winners rather than when the stock gets to full valuation, that's when I sell it. So, what is your plan to maximize winners? Well, I would just say, look, if your fundamental narrative is intact, why would you sell? If there's still upside to street estimates, why should valuation contract? And further, in my experience, best management teams find new ways to surprise to the upside. So if you get involved with a company like this, then you want to stay with those shares as long as you possibly can. So here's my conclusion. Stocks are worth more when fundamentals improve. Maybe that sounds silly, but a lot of people buy for other reasons. And I think your investment process should be focused on uncovering businesses that can have improving fundamentals. Thirdly, you're going to be wrong a lot. So acknowledge when you're wrong and have a plan to minimize losses, get out of the idea. And then lastly, when you do come across something that's really special and working, have a strategy to maximize the gains. Do not sell because you think it's at full valuation. That's all. I hope you enjoyed this video. Feel free to leave a comment or a question. And if you like, you can subscribe to my newsletter, which comes out on a monthly basis. Thanks very much.